It began quietly. Factories moving home, governments offering incentives, and global giants rewriting decades of trade playbooks. At first, no one paid attention. It just looked like logistics. But beneath the surface, a revolution was brewing. Today, we're watching the biggest transformation in global trade since the Industrial Revolution. A shift so profound, it's redefining how nations compete, how companies build, and how you and I buy everything we use. This is the story of how supply chain reshoring reshaped global trade forever. By the end of this video, you'll understand not only why companies are bringing production closer to home, but how this movement is redrawing the world's economic map. You'll see why this matters for your investments, your job, and even the price of your morning coffee. Because the reshoring wave isn't just about factories, it's about power, resilience, and the hidden forces shaping the next chapter of globalization. Stay with me. This one's big. Let's rewind to the late 20th century. The world was riding the high of globalization. Corporations discovered a golden formula: manufacture in low-cost countries like China, Vietnam, or Mexico, and sell to wealthier markets in the US and Europe. It was efficient, cheap, and wildly profitable. Just-in-time manufacturing became the religion of global business, minimizing inventory, relying on seamless logistics, and trusting the smooth flow of trade across oceans. But then, cracks started to appear. Trade wars, rising labor costs in Asia, geopolitical tension, and a global pandemic that froze ports and choked supply lines. Suddenly, those perfectly efficient global networks looked fragile, even dangerous. When a single factory shutdown in Wuhan could halt car production in Germany, executives everywhere began asking the same question: what happens if the next crisis hits? That's when reshoring or nearshoring stopped being a buzzword and became a survival strategy. For decades, economists told us globalization was irreversible. The logic was simple. Countries would specialize in what they do best, and the world would benefit from the efficiency. But that model assumed peace, predictability, and cooperation. Three things now in short supply. Let's look at the numbers. From 2000 to 2015, China's share of global manufacturing output surged from 7% to nearly 30%. By 2020, it was the factory of the world. Yet after 2020, a new trend began. In the United States alone, the number of announced reshoring and nearshoring projects skyrocketed. Semiconductor plants, EV factories, pharmaceuticals, industries once entirely offshored, were suddenly coming home. Why? Because the risks of distance had become too high. Every cargo delay, every political standoff, every cyber attack exposed a truth we'd ignored. Efficiency without resilience is fragility. Companies realized they'd optimized themselves into vulnerability. And governments? They jumped in fast. The US passed the CHIPS Act. Europe launched its Strategic Autonomy Plan. Japan paid corporations to move factories out of China. Reshoring was no longer a theory. It was policy. But here's the twist. Reshoring doesn't mean deglobalization. It means reglobalization. A reconfiguration of supply chains into regional clusters, North America, Europe, and Asia, each building more self-contained ecosystems. The world isn't shrinking, it's reorganizing. Let's unpack the deeper story. The psychology of reshoring. At its core, reshoring isn't just about manufacturing, it's about control. For decades, corporations traded control for cost savings. They didn't own the full process, they managed a network. That worked, until uncertainty became the new normal. Suddenly, control became more valuable than cost. In a volatile world, the ability to produce close to your market, to know your suppliers, to guarantee access to critical components, became a strategic advantage. Consider semiconductors. When chip shortages hit in 2021, global car makers lost over $200 billion. That wasn't a supply issue, It was a control issue. Now, the US, Europe, and even India are investing billions to build local chip fabs. Reshoring became the economic version of self-defense, and the effects ripple across everything. Jobs, skilled manufacturing roles are returning, but now they require automation literacy, not assembly line repetition. Costs. Products are getting more expensive, but more stable in supply. Investment. Private capital is flowing into industrial renaissance zones, from Texas to Poland to Vietnam. And for investors, that's where opportunity lies. Because when the world rewires its supply chains, trillions of dollars shift hands. New logistics companies rise, old exporters fall, energy demand patterns flip. Reshoring isn't a local event, it's a global domino effect. Let's look at how this plays out in real life. Case 1. Tesla and Mexico. Tesla announced a massive gigafactory in Monterrey, Mexico, part of a growing nearshoring wave to North America. Why Mexico? Because it sits within the USMCA trade zone, offers skilled labor, and reduces shipping times dramatically. Case 2. Apple and India. Apple, long dependent on Chinese production, began shifting iPhone assembly to India and Vietnam. This wasn't just about cost. It was insurance against geopolitical risk. Case 3. Intel and Ohio Intel's new Silicon Heartland initiative, a $20 billion chip manufacturing site, is reshoring at industrial scale. It's not just about producing chips, it's about securing national technological sovereignty. Case 4. Germany and energy supply. After the Russia-Ukraine war, Germany realized its energy dependency was a national vulnerability. Now it's reshoring not factories but energy systems, investing heavily in renewables and hydrogen hubs. Each of these cases tells the same story. The world's most powerful companies are no longer chasing the cheapest route. They're chasing the safest one. That's a paradigm shift, from cost efficiency to resilience strategy. So what does this mean for you, the investor, entrepreneur, or curious thinker? 1. Follow the capital flow. Where governments offer reshoring incentives, investment follows. In semiconductors, EVs, biotech, and automation. 2. Look beyond borders. Reshoring doesn't end globalization. It localizes it. Think in regions: the North American bloc, the EU cluster, the ASEAN triangle. 3. Invest in enablers. Automation, logistics tech, and energy storage are the backbone of regional supply chains. 4. Understand geopolitical risk. Every trade route now doubles as a power line. Knowing where risk lies and how it's shifting is modern economic literacy. 5. Think long-term. Reshoring is not a cycle. It's a structural rewrite of the global economy. Those who see the new map early will own the next decade. Here's the funny part. Globalization was supposed to make the world smaller, but in trying to make everything efficient, we made it fragile. Now, as we rebuild closer to home, we're learning something timeless. Resilience is the new efficiency. Factories may move, policies may change, but one truth stays constant. Every crisis rewires the world, and those who understand the wiring first, they're the ones who shape the future. Thanks for watching. Stay curious, stay strategic, and remember, the world's biggest shifts often start in the smallest supply chains. Subscribe for more deep dives into the money psychology behind global transformation.